The market's response to the latest FOMC meeting, what traders and investors need to know about what came out of the FOMC announcement, and Powell's presser. Today, my guest on the Futures Radio Show podcast is Senior Economist at CME Group, Erik Norland. Today's podcast is brought to you by CME Group. Whatever the obstacles, CME Group provides the tools that global market participants need to manage risk and capture opportunities. With 24-hour access to futures, options, cash, and OTC products across all major asset classes, you can drive your trading strategy forward with confidence and precision. CME Group, where risk meets opportunity. Erik, welcome back to the show, my friend.
Thank you so much for having me.
It's great to speak with you on such an important day, really. The day after this November FOMC announcement. Let's face it, we're getting into the end of the year. It's been a rough year for a lot of the stocks in the market. Some have done okay, and maybe we'll talk a little bit about what sectors have done okay. But for the most part, it's been just very difficult year for stocks. And really, everybody is looking to see what came out of this FOMC announcement. What are the things that traders need to know to really navigate into the end of the year? So you saw the FOMC announcement, of course, and then you watched Powell's presser. Talk to us about what we need to know that came out of this announcement.
Okay, so the main thing that I think came out of it is uncertainty. And so basically the Fed had been on a roll here. They had rates so far below the level of inflation that they had to get them back up quickly. So 4 times in a row, they raised 75 basis points each time, which is astonishing. It was the fastest pace of rate increases that we have seen in the United States since 1981. Now they have rates up to close to 4%, almost percent. So Powell basically told the markets that the Fed no longer knows exactly what it's going to be doing going forward. So when you look at CME's Fed Watch tool, for example, it's kind of 50-50 now between 50 basis points and 75 basis points for December. But the idea in the market is if they go only 50 in December, they're likely to go 50 more at the February meeting. So what it looks like is the Fed doesn't really know what it's doing going forward. It hasn't decided in advance how far it's going to move, but it has given an indication it's about to slow down its pace of rate increases. If they don't slow it down in December, they'll almost certainly slow it down early next year. They want to see how what they've done already is going to be impacting the economy, and there's tremendous uncertainty about that. On the one hand, we have the highest rates now we've had since 2008, which maybe will slow down the economy. On the other hand, with rates up to just below 4%, we still have inflation, core inflation at 6.5%. So they still have a negative 2.5% real rate. So in a sense, they're still subsidizing people to borrow money. So the Fed is in a situation where they don't really know what to do next.
And that really is difficult for people that are trading or investing in this market to really put any positions on because this uncertainty is so high at this current point. And you mentioned the CME's Fed Watch tool, which I think is the best tool. It's what I watch pretty much only thing that I watch going into Fed meetings is because instead of what people think the Fed may do, this is where people are actually putting their money to think what the Fed will do. And what I thought was interesting was that, well, going into the meeting, I think it was around 40 to 45% chance of 50 basis points. I think it was similar with 75, but the 25 basis points definitely had some love from traders because they thought maybe they'd go 25, right? And essentially that's just off the table now, right?
Yeah, essentially for the moment, nobody believes in 25 basis points for this next meeting coming up on the 14th of December. So it's really between 50 and basis points, which at this moment has a 52% chance, and 75, which has a 48% chance as of this moment. Now, 25 could always come back on the table. If we have, for example, really weak CPI data, really weak employment data, or a tremendous correction in risk assets, That could always come back on the table, but for the moment, it's not there.
Obviously, if they started to see the 25 basis point hike start to get a little bit more love, I think that that would have a market reaction. But I think right now, because it's 50-50 on 50 basis points or 75 basis points, I feel like the market is very comfortable with one of those two. So essentially, we're already going to start baking in that that's already going to happen, 50 or 75. And if we do start to see more towards that 25 basis points, I guess is that that's really almost a negative on the economy, right?
Yeah, I mean, well, so yeah, if they go only 25 basis points, it would be a sign that there's some sort of economic weakness or
Yeah.
financial weakness or something's going on.
So let's take that to the next part of the conversation and let's talk about inflation and how much that's impacting obviously everyday Americans. And with all the data that you're seeing, are we finally starting to see these interest rates have an effect where we start to see inflation start to come down?
Well, that's the really big question, and so I'll answer it in multiple ways. But I think the most maybe the best place to start is to look at the forward curve for inflation. So we have a forward curve that we can generate from the difference in yields on standard U.S. Treasuries and Treasury inflation protected securities or TIPS. And so the federal government, the Treasury issues TIPS with multiple maturities every year. So usually they mature, say, in like mid-January or early February, but they have other maturities. From those, you can construct a forward curve for inflation. And what that forward curve says to me is kind of fascinating and shocking at the same time. That forward curve basically says that the bond market is pricing that we go back to 2.5% inflation immediately, like starting in October for that number that's going to come out next week. And so the market is pricing 2.5% inflation annualized for the remainder of this year, for next year, the year after that, and then eventually kind of dropping down more towards 2% inflation over the very long term, going out to the 2030s, 40s, and 50s. Now, I look at this forward curve for inflation in the bond market, and I just find it impossible to believe, at least in the short term. Now, I can imagine inflation going back down in the long term, but in the next few months, I just don't see it. There is. Let's play devil's advocate though, and say advocate in favor of this forward curve. So, there are a few things that do show signs of inflation easing. One big area is supply chains. So supply chains, hit all these bottlenecks. A lot of those are easing, and you see that very clearly in certain pieces of data, like the Shanghai to Los Angeles freight rate. Before the pandemic, having a container on a ship cost usually a little less than $2,000. Then it went up to $12,000 per container. Now it's come back to around $2,500. There's been a lot of easing into trans-Pacific trading relationship. I think like trucking in the U.S., other things like that, the prices are not so bad. You also see oil prices dipping a bit too. They're $120 a barrel in June. Now we're back down below 90. So there are specific instances where you can point out that inflation is eased. But most of the costs in the economy are wages, and wages are still growing at over 5% per year. The labor market is still super, super tight. We just got the JOLT survey, the Job Openings and Labor Turnover Survey, earlier this week. It showed employers looking to hire 10.7 million people. Where do you find 10.7 million people when you're at full employment and your unemployment rate is essentially tied for a, 55-year low or so, 54-year low of 3.5%. So there's a lot of upward pressure on wages. And I think that you also have tremendous upward pressure on housing costs. Now, the fact that mortgage rates went from 3% to 7%, what that does is it takes people who would be home buyers and forces them into the rental market. The U.S. has a record low vacancy rate for rentals, 1.5%. So as more and more people try to compete to rent these properties, the cost of rents go up. and rents are 30% of the CPI. So imagine that rents go up 7% in the next year, which is basically what they're increasing at the moment. Um, so 7% times 30%, that's 2% inflation before you've even measured anything else in the CPI, the rest of the 70%. So the rest of the 70% comes in, say, just 2%. You have 3.5% inflation. That's above the market's expectation. But if you say that inflation and the rest of the index comes in more towards 4%, which is a gap between wage growth at 5% and productivity growth, which is coming in generously at 1%, then you're suddenly looking at an inflation rate more like 4 or 5% for the next year, close to 5%. So I find this bond market pricing of inflation just almost impossible to believe.
So let's talk about that. Why do you think that the bond market is pricing that then?
I just don't know. I just don't understand the prices. One argument is that the bond market is still really distorted from all the quantitative easing. Is the Fed bought, standard U.S. Treasuries, so they also bought some tips. Now they're reducing the size of their balance sheet. So there are people who argue that the bond market is just not reflecting reality because it's so distorted by all of this quantitative easing. I find that a little hard to believe, though, because if you're the break-even inflation should be the point at which investors are indifferent between holding a tip and holding a treasury. So if they really do believe that inflation is only going to be 2.5%, then okay, I can see that. But on the other hand, if you believe that inflation is going to come in higher than that, it would be a really strong argument for holding tips in the portfolio, especially now that those tips are now paying positive real yields. So now you're getting inflation plus a couple percent, which is a really, really big change from where we were a few years ago.
So what are the repercussions to the marketplace if the bond market gets this wrong and inflation does come in higher? How does that start to impact the market?
Well, so I think that this really gets down to the question of where is the Fed's terminal point for interest rate increases. And so Jerome Powell kind of suggested that, okay, they're going to slow down the pace of increases, but he hinted that the ultimate terminal rate could wind up being a bit higher. So now the market's kind of pushed up that expectation for the terminal rate up towards 5%. But let's say that the market kind of gets this wrong and inflation turns out to be a lot stickier. In the past, when we've had high and sticky inflation, the Fed has often had to raise rates to positive levels in real term. So in other words, to inflation plus some additional on top of that. And sometimes it's gotten really extreme, like in the early 1980s, the Fed went to inflation plus 7%. If they did that today, we'd have rates at like 13 or 14%, which is very hard to believe. But imagine we next year have 5% inflation, and it turns out to be really sticky, and it's not going away quickly because wage growth is still really strong. People have a lot of bargaining power in that labor market. And it's conceivable the Fed say, okay, we need to put rates at inflation plus 1 or 2%, get it up to 6-7%. That's going to come as a huge, huge shock if that happens to the bond market. I mean, we have 30-year yields now at 4.15%. And we have 10-year yields at 4.13%. I'm kind of glancing at my screens over here. You have 5-year yields at 4.36%. So, I mean, this could really come as a major, major shock to markets if inflation does not go back to where the tips versus treasuries break even suggests that it should go.
Yeah, I mean, it's crazy to think that a market could have something priced that wrong when of all of the reasons that you just talked about, right? I'm not a bond trader, so I can't think about why they're pricing something like that. But let's talk about the 2-year, 4.67 right now on the micro treasury 2 years. You've got the 5-year at 4.37, the 10 at 4.12, and the 30s at 4.16. It appears to me as though this, at least in the short term, this chart is probably going to continue to stay as it is with all of these, based upon what we're hearing from the Fed.
Yeah, it's really hard to say. I mean, I think that the upside risk is that inflation remains really high. And you mentioned, like, can the bond market be this wrong? And I guess the short answer is yes. If you rewind, say, to 1 year ago today, you go back to, say, the 3rd of November, 2021, and you looked at where bond yields were a year ago, particularly at the really short end of the curve. Like, take Fed funds futures. Fed funds futures 1 year ago said that today the Fed might have raised rates to 50 basis points. So the market thought a year ago that the Fed in the next 12 months, meaning the year ending today, might have raised rates either 25 or 50 basis points. And so here we are, the Fed's already raised rates nearly 400 basis points, right?
Yeah.
So yeah, the short answer is that yes, bond markets can get things massively, massively wrong. And the thing is that the bond market's trend has been very strong, and is that trend over or does it continue? My sense is that there's a strong risk it could continue, but there's one major or a couple major risks on the other side. So one major risk on the other side is we have some sort of massive financial crisis. That can happen in the US, for example, if we see the stock market going into a really, really big sell-off, like say a 1987 style sell-off. That could push bond yields back down, or it could happen abroad. In 1998 and 1997, for example, we had the Asian crisis and the Russian crisis. And during that time, mainland China was largely spared, but now China has massive levels of debt. If the Chinese economy really starts to go into a deep recession, which is possible given the COVID restrictions, the problems with their property sector, et cetera, that could really have devastating consequences for commodity prices. And if we see continued declines in commodity prices, which we have been seeing for these past several months, that can actually take a lot of pressure off of inflation throughout the world. So I want to make clear that even though I think inflation may be a lot stickier than the market thinks and the Fed thinks, that there are risks in the other direction as well.
Yeah, and I just want to show everybody this is just this year for the 2 year treasuries. It's incredible, right? I mean,
Yeah,
it's a
50 to 4.5. That's huge.
exactly. And which brings me to I think the next thing we should talk about here is let's talk about the possibilities of a recession. You watch all the data, you watch it closely. Like I said, I'm not a macro person. I'm just a trader out there who uses mostly charts, but I always like to watch the numbers. And I've been through recessions before, and earlier I would say this really felt like a recession because that's really a lot of what I go off of is kind of my feel and just go out there and talking with people. I think that's a great sense of really figuring out if we are truly in a recession. And I would say 6 months ago it felt really like we were going to get in one, and now I don't feel that as much. What is the data telling you about the possibilities of a recession?
Yeah, it's a tough question. So I think, I like looking at polling data a lot. And so one of the pollsters, YouGov, sometimes asks people the question every few weeks or so, is the economy in a recession right now? And a large majority of Americans say yes, the economy is in a recession right now. So I think to a lot of people, it feels like a recession because on average, wages are up 5% in the last year and prices are up 8%. So, if you're kind of the average working employee, you've seen your purchasing power drop by 3%, and that's pretty bad. And so, all of this is constraining growth in consumer spending. You see consumers making tougher and tougher choices now. We also had 2 straight quarters of negative GDP growth, which is, I should say, barely negative GDP growth, but then followed by barely positive GDP growth in Q3. So we've had really stagnant growth in GDP. But the reason why most economists would say this is not a recession is because we continue to see very strong gains in employment.
Yeah.
Employers are still hiring like mad, and they still have 10.7 million open positions. In terms of what the markets are saying, I'd say 2 things real quick. First, we are starting to see now the first full inversion of the yield curve, where we have like 3-month T-bills above 2 years, which in turn are above 10 and 30 years in terms of yield. So now we're seeing a full inversion of the yield curve. That full inversion of the yield curve often signals a recession coming, not always, but it often signals one that could take place anywhere from 6 months to 2 years in advance. So we may not meet that technical definition of a recession. We start seeing rising unemployment, sharply falling final consumer demand for many months. It may take 6 months, a year, or 2 years, something like that. The other indicator I think is really, really good for this is credit spreads, particularly if you look at high yield bonds versus treasuries. Right now, high yield bonds are trading, I'd say, at about 5 to 6% yields over treasuries of similar maturity. That's up from 3% at their low, so spreads have widened a bit. But usually when you get into an actual recession, the short-term indicator will tell you you're kind of in one imminently, as the spreads go up to more like 8 to 10% above treasury yields, and we're not there yet. So the fixed income markets are starting to flash warning signs that a recession might be coming, but we're not really there yet, at least not according to how the National Bureau of Economic Research would define a recession. But the average American might say we're in a recession already.
Yeah. Yeah, because sentiment a lot of times can drive a recession, right? If people start to think that we're in a recession, it almost can cause a recession in its own right? Because even with people with money, they might look at everything and say, well, you know what? We're going into a recession. They start slowing things down and they start spending less. So it's interesting and how you say you look at like the polls and things like that. And I said, I just go to see how people feel in the street. And I feel like a lot of the people I know are definitely very unhappy with the amount of inflation that we're seeing. And it's definitely impacting most people that I know. And which really brings me to the next thing, which I think is really, it's the big story, right? I know we talked about how interest rates looked, right? We talked about the 2, 5, 10, 30, and you talked about what's happening on the 3-month and how that yield curve looks. But the dollar, I mean, this dollar. Every time I am trading, I look at that dollar again. Another big day today. It's almost at 113 on DXY. And it just hurts everything else, right? It hurts stocks and it has that impact across the board. What are your thoughts on the dollar?
Yes, I think the dollar's been extraordinarily strong, as you point out, against many, many currencies, against the yen, against the renminbi, against the euro, the pound, the Canadian and Australian dollars, et cetera. It's just been a really, really strong currency. But you look at it there, it kind of hit its peak so far anyway. I'm not saying it hit its ultimate peak, but
Yeah.
it kind of hit a wall there in late September. And I kind of wonder if we're getting near the ultimate top in the dollar. And the reason why I wonder that is as an analyst of currency markets, I think there are essentially 4 forces that move currencies. So for a long time, a lot of those forces were pulling the dollar upward. So first, the U.S. economy grew much more strongly coming out of the pandemic than Europe and Japan and most other economies did, in large part because the U.S. government just did so much. The stimulus was just so big in the U.S. In the U.S., we took the budget deficit from 5% of GDP, which is already big, to 20% of GDP at the peak of pandemic spending. That was twice as much spending relative to the size of the economy as we had in Europe. So U.S. consumer spending flew off the charts. I think that's a lot of what caused all these supply chain disruptions was that demand just outstripped supply. So that helped to send the dollar soaring because the U.S. economy was just growing too quickly. Secondly, because of that, monetary policy came in. Monetary policy is a big influence on currencies. Because the U.S. saw its inflation increase more quickly and sooner than Europe did or Japan did, the Fed began tightening policy much more aggressively and much sooner than the European Central Bank did, or, for example, the Bank of Japan, which still hasn't even started tightening policy. And now that's starting to shift. So these 2 factors are starting to change. Now the U.S. economy is essentially ground to a halt. It's not really growing anymore except in the jobs market. Whereas Europe and Japan are still kind of muddling along and recovering. And then secondly, the Fed's now talking about slowing down its pace of rate increases, whereas the European Central Bank, the Bank of England, are actually accelerating their pace of rate hikes. And the Bank of Japan is starting to contemplate, for the first time, getting out of yield curve control because their inflation rate's actually coming up towards and even past its target of 2% for the first time in decades. So I think there's a lot of changes coming in the pipeline. The one thing that may continue the dollar rally is just that it has a lot of momentum. And it's, especially as other parts of the world experience financial distress, sometimes that creates panic buying of dollars. So I think the fundamentals are starting to change against the dollar, but there could be a lot of momentum buying and stress buying around the world as different countries run into financial crises as a result of higher interest rates in the U.S.
Yeah, no, I mean, that makes perfect sense. I mean, the Fed is at the end of their cycle, and then you have other central banks really just getting started, right? So just common sense would think that this should start to change things. And actually, let's pull up the euro there because I mean, look at the euro. This is the 6E at CME, and you look at it. Obviously, it's just a straight down because it's tied to the dollar. Talk to us a little bit about European central bank policy.
Well, so the ECB is pretty early on in their cycle. The ECB didn't even begin moving rates until July.
Yeah,
So they did this initial increase where they went from negative 50 basis points to zero. Then since then, they've done two 75 basis point moves, which for them is extremely aggressive. So they now have, the ECB essentially has two major policy rates. They have the deposit rate, which is now up to 1.5%, which is essentially the rate at which European large banks can deposit money with the central bank. Then they have what they call the main refinancing rate, which is now up to 2%, and that's the rate at which those same banks would be able to borrow funds from the ECB. But Europe is, I think, in a very challenging situation. In Europe, core inflation is a little bit lower than in the U.S., but it's still very high. It's now up to 5%. So you think about this, the central bank here in Europe has a 2% main refinancing rate, but 5% inflation. That's a negative 3% real rate. And so they're still really, really far away from their rate of inflation, which could cause them to keep hiking aggressively for at least several more meetings. The other thing about the ECB is ECB meets essentially 11 times per year. They skip August, where everyone in Europe is on vacation. But
yeah.
aside from that, they meet monthly, where the Fed only meets 8 times per year. And so the ECB could potentially go pretty quickly here towards tightening further. But the ECB also faces one problem that's very unique to Europe that is very different than the United States. In the United States, we have one central bank, and we have one federal government that issues debt into that currency. In Europe, you have one central bank, but then you have 17 not really sovereign countries issuing debt into a common currency. And so what's happening in Europe is as they raise rates, it's just creating a lot of stress in economies that investors perceive as being weaker economies, particularly Italy, for example. So Italian government bonds now see their yields up to 4%, whereas German government bonds are still trading at around 2% yields. And so some countries like Italy have colossal levels of public debt, and it can become really, really difficult to finance if the ECB keeps raising rates. There's one final problem in Europe that's also, I think, quite unique, and it's also very country by country. In the United States, for example, when you take out a mortgage, for the most part, Americans take out fixed rate mortgages of, say, 15 or 30 years and have this beautiful option to refinance them. In Europe, there is not only no refinancing option in most mortgages, but in certain countries like Spain, or for that matter, the United Kingdom, where I live, almost everybody's on some version of a floating rate mortgage. So when the central bank raises rates, almost immediately that jacks up everybody's mortgage payment, which has a killer effect on consumer spending in those countries. But in Europe, the ECB is trying to make policy for countries like Spain, where everybody's on ARMs or adjustable rate mortgages, but they're also trying to make policy for countries like France and Germany, where everybody's on fixed rate mortgages. So they're having, everybody's economy is different, is all doing different things, and it's just going to be really, really challenging. And Europe also has extremely high headline inflation of over 10% because our cost of natural gas has gone to the moon. In the United States, natural gas is pricing at like $6 to $9 for MMBTU. In Europe, those prices over the summer got as high as $60 or $80 per MMBTU. They've actually come down a lot in October because we've had a warm October. But when the Russians turned off the gas pipes and Nord Stream 2 mysteriously blew up, it just created a huge economic shock here for the ECB to deal with. And they're kind of dealing with a simultaneous demand and supply shock, where the Fed is dealing really only with the demand shock.
Let's go to oil and commodities. And I said this earlier. I said the dollar really is the story because let's just look at the board, right? So this is the quote board I have. You've got 2, 10, 5, and 30s all up today. Dollars up, and then look at everything else. It's down, right? That's why I say the dollar is just such an important market to watch because it's impacting everything. And I think you look at crude oil, right? And here's crude oil for the year. And this is one of those markets where pretty much every macro person that I follow has been bullish oil, really not only just this year, but going into a large part of last year. And we saw this massive move higher. And now we've just really, when did we hit that? March, right? I think it was obviously right at the beginning of when with the Ukraine and Russia. So yeah,
Yeah,
March.
kind of like early March, and then it kind of double peaked again late
Yeah,
in June, I guess. Yeah.
yeah. And then since then, it's obviously come down, as you could just see here in the chart. What is your current take on oil?
So my current take on it is that oil is experiencing extremely strong cross currents. So on the one hand, you have certain factors that are very bullish. OPEC has slashed production by OPEC plus, I should say, OPEC plus Russia has slashed production by 2 million barrels per day. It's about 2% of global production. And kind of the rule of thumb is when you take 2% off the market, you might expect a 20% up move in prices, but we haven't seen that. The other bullish factor is that inventories are extremely low. Crude oil inventories are kind of about average, but they're just unbelievably low inventories for diesel, or ultra low sulfur diesel, as it's now called, formerly known as heating oil, and gasoline have really unseasonably low levels of inventory. So there's a lot of upside price risk stemming from that you see in the options market. When you look at the options for oil, you have a strong positive skewness. So the call options cost a lot more than equivalently out of the money put options. So people are kind of pricing this risk of some extreme upside move. But as you see here on this chart, oil prices are way off their high, and they didn't respond so much to that the OPEC plus production cut. It happened just about a month ago at the beginning of October. There was kind of like a small rally, and then it just fizzled out. So what's going on? What's the downside risk? Well, part of the downside risk you pointed out is the dollar. So oil is priced in dollars.
Yeah.
So this is the American price of oil. But if you experience the price of oil like I do here in the United Kingdom, we ultimately buy it in pounds at the pump. So our weaker currency, the price hasn't really fallen so much in pound or euro or yen terms. So it's still kind of killing demand in the rest of the world because we have a strong dollar and weak other currencies. So from the perspective of other currencies, oil is really expensive. But secondly, you have China, which still has these COVID lockdowns. They put the city of Wuhan, where all this began, back in lockdown. Something like 25 or 30% of people in China are under some form of lockdown at the moment. And that could get worse over the winter when diseases tend to spread more rapidly than they do in warm weather. And then secondly, you have the property collapse in China, which is ongoing. So you just have really extremely weak growth there. And then lastly, you have central banks sending interest rates soaring around the world, which is ultimately going to dampen consumer demand for all manner of goods, including for oil. So I think that you look at the airlines, their bookings are way down now because people are just afraid to spend money. People are not driving as much, et cetera. So I think that oil is just really struggling here. And it looks like maybe OPEC plus, in a sense, if they wanted to balance the market, was right, in fact, to have cut production.
And let's talk about commodities now too, because obviously this is a big part of the story. It's everything's a big part of the story right now. I was looking at corn the other day, and look at corn is starting to rise again. I was looking at wheat; they're down today. Once again, I think it's if the dollar is up, I just see that impacting so many things. Like I said, as the trader in me, you just have to keep an eye on the dollar. But overall, you're starting to see these things gain strength again. We saw these big sell-off in corn, and now it's stabilizing, coming back up. And wheat is another one, not quite as strong as corn has been lately, but once again, I wonder what happens to oil, to corn, to wheat if all of a sudden we start to see this dollar pull back, right? I mean, obviously it could be good for stocks, I think, as well, but I think you could start to see these commodities start to go higher.
Yeah, so I think it's really hard to say. I mean, it depends on a lot of different factors. There's a lot of obviously non-economic factors that influence these markets.
Yeah,
The weather, we still have this kind of strong La Nina pattern in the Pacific, which is sort of wreaking havoc with weather everywhere on the planet, creating droughts in some places like the United States, creating flooding conditions in other places like in Australia, where I was last week. They've been having unbelievable rains there, unbelievable flooding. They also have a wheat crop there. It's not huge, it's maybe 1% or 2% of global wheat production, but still. And then, of course, you have all the uncertainty in Ukraine, which I wouldn't say is really, necessarily economically related. But you essentially have, the Ukrainians and the Russians. Neither one is in a position where they can back down. If Ukraine backs down, they lose their country. If Russia backs down, Putin potentially loses his regime. So you have a lot of uncertainty there. But on an economic level, you have stocks to use ratios, which are kind of low at the moment. So the inventories of these products is not particularly strong at the moment, which is worrisome given these potential supply disruptions. And you, in addition to that, have a very strong relationship between all of the agricultural goods, especially corn, wheat, and soybean oil, and crude oil. Those commodities are very closely related to each other, I think, for two reasons. First, agriculture is a very energy-intensive business, so it's a big portion of the production costs for farmers, both indirectly and directly. And then secondly, a lot of these crops can be turned into biofuels. And so the biofuel prices are influenced by the price of other kinds of fuels like diesel and gasoline, et cetera, because they get mixed into those blends. And 65 countries around the world, including the US, the EU, Indonesia, China, have some sort of biofuel mandate. And so the oil market and these other markets, the crop markets, are very closely connected. And of course, they are all influenced by the dollar, which happens to be relatively strong. And the dollar may be actually sort of limiting their gains from a dollar perspective,
exactly.
but not from the perspective of any other currency.
Yes, exactly. Right. I mean, that's, just to mention, I was looking at the headlines earlier, and wheat had dropped today. I mean, I mentioned, part was the dollar rallying, but the Ukraine grain export deal resumed again. And these are the things that are going back and forth. But I look at the dollar and say, if it does start to actually come down, I'd be curious with the uncertainty with some of these commodities, with oil, that all of a sudden they start having a little bit of a boost, just because of that dollar move. So I think that that's just something that is, from a trader's perspective, it's very interesting to watch, because all of a sudden, what does that potentially do to inflation? What does that do to potentially a recession? All of a sudden, the Fed may have to shift.
No, I think that's absolutely true. I mean, the dollar is the pricing currency for all commodities, or substantially all commodities. And so its movements relative to other currencies can have a big impact on commodity prices. It doesn't explain everything, but it may
Yeah,
explain 20 or 30% or more of what's going on. The other thing I'd point out is that we think of the dollar as a currency of the United States, which is true, but it's a lot more than that. Saudi Arabia, United Arab Emirates, Kuwait, Bahrain, Oman, all of those countries essentially use the US dollar. Like, they have their own currencies, but their currencies are linked to the dollar at fixed exchange rates. The same thing with a lot of other countries you don't even think about. Like, this is to me amazing, but Cuba essentially uses the US dollar. Even though we
really,
don't have very
I didn't
friendly
know that.
relations with them. Yeah, there's a lot of countries that use the US dollar. And then you also have the phenomenon of other countries that have borrowed a lot of money in US dollars, like Nigeria or Sri Lanka or Lebanon. And so as interest rates in the US go up, financing costs don't just go up for Americans, they go up for all of these other countries. So it has enormous global repercussions. The Fed is essentially the central bank for dozens of countries, not just the United States. And so its monetary policy and its currency that it issues is of global consequence.
Let's turn to gold here because let's actually talk about gold, silver, and copper. We haven't talked much about the metals lately, us as traders, just because let's look at the chart. I mean, let's be real. It's not been the easiest year for traders when you
No.
look at gold. You look at silver. And it's funny. We talk about this all the time. A lot of our trader groups. Gold is not a true hedge against inflation, right? It doesn't seem to ever work that way, at least. And I know some people will argue with me about that, but nonetheless, you have gold on the lows of the year, silver, not as weak, but obviously silver is a different play than gold. I know a lot of people will talk about silver and gold in the same sentence, but they are obviously different. And then let's just take a look at copper, and you see what copper's done looks somewhat similar to silver, and those two I think could be a little bit more comparable. But the precious metal space, I mean, what are your thoughts on what's going on there this year?
Yeah, so the gold really has a very strong uh, a negative correlation to two things. So
Interesting.
the first, not surprisingly, is the U.S. dollar. So a stronger dollar is terrible news for gold.
Yep.
But then secondly, and independently of that, gold has an even stronger negative correlation with the level of short-term interest rates in the United States. So
Yep.
the fact that the Fed has sort of unexpectedly, if you will, I mean, given that the market didn't really see it coming, raised rates 400 basis points has not been the best piece of news for gold. Yeah, so gold rallied kind of for a few minutes yesterday when before Powell spoke, and the market thought, oh, good, they're going to pivot to slower pace of rate hikes. And then after Powell spoke, people were a little less clear on that. So gold started to sell off again. Higher interest rates are anathema to gold because gold is essentially a currency that pays no interest. Um, so I think gold will really, really prosper when the Fed really does stop raising interest rates for whatever reason, because inflation has subsided or because the stock market crashed or whatever reason. I think gold really will prosper. Silver and copper I would say, well, copper is definitely an industrial metal. So it's kind of in a different ballgame. The copper market responds very strongly to what happens in China. And so China's property collapse is not great news for copper. And neither is the fact of higher interest rates in the United States, Europe, and many other countries, because that pushes up mortgage rates, which reduces the need for home construction. And a huge portion of copper goes into people's homes. I think in the United States, the average home, when you count all the wiring and other things, has something like 450 pounds of copper in it. It's just a tremendous amount. It's like a quarter ton of copper in the average American house.
Wow.
So as mortgage rates soar and kills property development, not just for houses, but also for offices and other things, that's really rough news for copper. Um, Silver is kind of its own animal. Silver underperformed gold really, really badly for many, many years in the last couple of decades for a strange reason. You dial back 20 years ago, the main use of silver was photography. Like, I know for like the millennials, this is so unbelievable. You used to like take photos, you had to go to some place and get it developed, and you
Yep.
would use silver to do it. So that wiped out almost like a third of the demand for silver. So silver was a big underperformer versus gold for a long time. It used to be that 1 ounce of gold used to buy like 30 ounces of silver, then eventually became 120 ounces of silver. But silver has snapped back for an interesting reason that also impacts copper. So copper has China and real estate to worry about, but both of them are beneficiaries of the energy transition. So, if we want to get off of oil, we have to get onto solar, wind, batteries, electric vehicles, et cetera. All that requires huge amounts of copper. It also requires a little bit of silver, but one of silver's big new uses is in solar panels. So silver is kind of finding a new use there. And then, lastly for silver, after the Queen died, Queen Elizabeth II, the United Kingdom is going to issue some sort of silver coin, in her memory. And there's been tremendous demand for that. So it's also been kind of stoking silver. You kind of mentioned that silver has outperformed gold a little bit these last few weeks. That may be among the reasons.
Oh, That's interesting. I did not realize that what was going on there in the UK with the Queen. And it's, well, you think about how many millions of people could be going to buy it all at once, right? I mean,
Yeah. I mean, the
it's
thing is, you think of her as the Queen of England, but that also includes the rest of the United Kingdom, Canada, Australia, New Zealand, um, and a number of other places around the world. Of course, she had many admirers outside of the UK and the places she was officially reigning in throughout the Commonwealth and elsewhere.
And let's face it, she was an extremely popular person globally. So a lot of people may even just want to participate. That's an interesting kind of little thing there about silver that I had not heard until you had mentioned that. But Erik, we'll wrap it up there. I know we covered really the whole spectrum today, and maybe I'll just let you leave with some final comments and just kind of summarize. Once again, a lot of this was about this recent Fed meeting, what came out of the presser, and just what we're looking at the end of this year going into next year in markets.
Yes, I think that the biggest question facing markets is, does inflation come back in line with the expectation for inflation in the bond market? And that will play a big role in determining how interest rates behave relative to the forward curve. So the market thinks inflation is going back to 2.5%. The forward curve essentially prices that the Fed ultimately peaks out somewhere around 5%, give or take. And then that, of course, has a huge impact on longer-term interest rates, which in turn impact the equity market, which is very closely connected to longer-term interest rates. And it also impacts what happens to the dollar, which impacts commodities. So as you rightly point out, all of this is very, very tightly interlinked, but in ways that are very, very complex with lots of feedback loops.
It's always great to speak with you, my friend. I want to mention everybody, go to cmegroup.com. We also mentioned the Fed Watch tool. There's a whole bunch of other stuff on there that's really great. CVOL, we didn't talk about that today, but that's a great tool. There's a bunch of great tools there. And also follow CME Group on Twitter. I highly recommend you stay in touch with what Erik and Blue are doing. Blue was on here last month. I love Blue. He still rubs it into me that he beat my ass in tennis. Not happy with Blue. He likes rubbing that in every single time. I tried to take it light on him, Erik, and he just was firing serves at me. So it was pretty funny. But, I love you, Blue. And Erik, once again, thank you so much. It's always great to speak with you. You'll always have a special place in my heart. The first video I ever did for Futures Radio Show with CME was with you. I don't know if you remember that.
Oh, really? Yeah, back around 2015 or 2016 or something like that.
It was
Yeah, that was
my
fun.
first steps into video. Every time I see you, it brings back those good memories. And of course, I love all of your content. I really appreciate it. All right, Erik, thank you again so much for joining me today.
Thank you.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.